Hi, I'm Joe Collins from Avalon Accounting. If you run a small business, chances are you've had the conversation with someone about what you can write off. Most of us have been regaled with that story at cocktail parties with the business owner who writes off all kinds of crazy expenses and gets away with it. Unfortunately, these stories just cause headaches and confusion, and today I'd like to clear some of that up. So today I'd like to talk to you about what you can legitimately expense in your business and what might be a gray area. But not only that, I want to give you the framework on how to make that determination yourself. So if you're watching this video, chances are you have a very specific question about a very specific expense. Can I expense X? And while that's a very valid question, the challenge with answering it is that different things can be expensed under different scenarios. So what I'd like you to take away from this video is the framework on how to make that determination on that specific expense yourself. Okay, so according to the Government of Canada, you can deduct any reasonable current expense incurred to earn business income. Now that's a mouthful, but I'm gonna go into detail on each aspect of that. So one word you may have picked up on in that description is the word current. Here's the difference between a current expense and its counterpart, a capital expense. The idea here is that a current expense can be deducted in the year that you incurred it, and a capital expense is going to be deducted over the useful life of that purchase over a few years. Some criteria that differentiate a capital expense versus a current expense are, number one, a lasting benefit. A capital expense is going to have a benefit to your business of more than 1 year, whereas a current expense is going to have a much shorter benefit period, usually less than 1 year. Number two is maintenance versus improvement. A capital expense in this scenario is going to improve your property to better than its original form, whereas a current expense example is if you just restored your property back to its original form. Number three is new assets versus repairing of old assets. So a capital expense is really clearly something that you buy that's new versus repairing an old piece of equipment or something like that, which might be more of a current expense. Purchasing a new computer is a new asset and provides lasting benefit, so could be considered a capital expense. Replacing wooden stairs with concrete stairs would likely increase the lifetime of those stairs, so could be considered a capital expenditure as well. Purchase of a new telephone would be considered a capital expense because it's a new asset and has lasting benefit. Alternatively, repairing an old computer to get it functioning again would be considered a current expense, as it's just bringing that computer back to its original form. Replacing wooden stairs with wooden stairs and bringing those stairs back to their original condition would also be considered a current expense. Paying your phone bill monthly would also be considered a current expense, as it recurs over a short period of time. The next issue to consider is whether an expense is reasonable and whether it's incurred to earn business income. For example, it's likely reasonable for a software developer to deduct something like internet costs, but it's likely not reasonable for a construction contractor to do the same. The issue is whether the expense is actually used in the business to either earn business income or grow the business. The other component is that you may have a business expense that has a personal component to it. Now, the personal component would not be eligible to claim. For example, if you use one phone for both business and personal, it's probably reasonable to claim a portion of that phone to a business expense, but there would also be a personal component that would not be deductible. Now, you will have to estimate the business portion of that phone bill, keeping in mind that the business portion should be reasonable. Using the same thought process, personal expenses like going on a vacation, maybe some meals and clothing, are not going to be deductible because we can't link them to earning business income. Now, it wouldn't be tax law without some exceptions and special circumstances, so that's one we're going to go over next. So number one is meals and entertainment. When meals and entertainment expenses are incurred for earning business income, they're still only 50% deductible for tax. It's important to keep track of the reason for that meals and entertainment expense. If you just forgot your lunch for the day and have to go out and buy it, that's not a deductible expense. However, if you're taking a client out for lunch and you're paying for that, it's still 50% deductible for tax purposes. Now here's a bonus. For meals and entertainment, we as business owners get 6 events per year that we can deduct 100%. The stipulation is that you need to invite everyone from the office. The other maybe misconception out there I hear sometimes is that alcohol is not deductible under this 50%, but it most certainly is. If you go out for a beer with a client or a staff member or something like that, you can deduct that expense, still at 50%. Another expense that has special rules are vehicle-related expenses. So while the business portion of anything that you're incurring to run a vehicle is deductible, you need to follow some special rules to make sure you get those deductions. Now this is a pain, but you're going to need to keep track of your business use of your vehicle versus your personal. And this can be as easy as using an app on your phone like MileIQ, or you can keep it manually in a logbook in your car. So what's included in this deduction? Things like fuel, maintenance, insurance, registration, things that are transitory in nature that you use to keep your vehicle running are going to be deductible for this. All right, now an important note here is that just because you own a business doesn't mean your commute is all of a sudden deductible. You're treated the same as an employee and you need to get yourself to and from work with no tax deduction. Number 3 is home office expenses. If you run your business out of your home, you can deduct a portion of your home costs. Now, much like vehicle expenses, this is going to be a portion of your home rather than the whole thing. Now, the way to calculate this deduction is to, 1, find a reasonable allocation of your home and what's business use, and that could be a square footage over the total square footage of your home. So you come up with a percentage. And then you multiply that percentage by the expenses that you incur to run your home. And that can be mortgage interest, insurance, property taxes, things like that. Now, ending on a bit of a sad note here, gym and golf memberships. These are specifically excluded from being able to be deducted within your business, even though we can all agree they can help you earn business income and they can actually make you healthier and a better business owner. So that's it, a pretty quick overview of what kinds of expenses you can deduct as a business owner. Check out the links below for additional resources and information. Thanks for watching, and don't forget to subscribe so you don't miss out on any new videos for entrepreneurs just like you.